Everybody is talking about how the United States debt was just downgraded and how this could lead to a crisis.
It is a warning sign, quite frankly, that the United States does not have its financial house in order and hasn't for a really long time, and there will be a price to pay for that.
When we see downgrades like this, it typically makes the cost of borrowing more expensive for the consumer.
So the question becomes, is it time to panic? The answer is yes, but not for the reasons you're hearing in the mainstream financial media. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over why this downgrade happened. Well, it's pretty obvious. We start with a chart of the United States debt itself. Today's date go all the way back to 2000. On the left, we go from 4 trillion, almost a cute number, up to 40 trillion. And you can see back in 2000, we were right around, let's just say 6 or so. And then in 2005, we get up to about 8. And then to GFC, it really ramps up. Now, what I want you to notice is really the trend, how it's really increased in 3 different stages based on a recession. So what I'm referring to is if you just take this trend line that we were on prior to the GFC and extrapolate that forward, I'm doing the best to draw a straight line there. You can see that just eyeballing it, we'd maybe have, let's just say $12 trillion in debt. But then if we fast forward to the GFC, you can see we had this bump up and then the trend becomes a lot steeper. So if we take this line straight out into where we are today, we could say the debt might be around 28 trillion. But you guys know the debt right now is not at 28 trillion. It's all the way at about 36, 37 trillion. So then we have the cerveza sickness, and very similar to the GFC, it goes straight up, but then once it starts leveling out slightly, it still goes up at a faster rate than it was going up during this time frame or post GFC. So this trend line once again becomes steeper. So if we take this out, let's just say, 5 years into the future, I don't see why the United States debt wouldn't be $50 trillion, if not higher. And this is really the key. So when a ratings agency looks at this, they see the spending and how the uncontrolled spending, even in the big, beautiful bill, it might be big and beautiful, but I can assure you it's going to be expensive. So they look at the government spending like a drunken sailor, your drunk, insolvent Uncle Sam, and then they say, my gosh, this is going to lead to these huge deficits, especially if we have an economic slowdown. Because most of you know that regardless of what the debt to GDP is right now, say 5 or 6, if we go into a recession, what the United States and the government has proven over and over and over again is they're going to spend even more money, and that deficit to GDP is going to increase. Editor, I'm sure you've been throwing up a chart to illustrate exactly what I'm referring to. So then these deficits blow out, the debt to GDP goes higher and higher and higher. And why is this a problem? Because the GDP is, let's just say, a proxy for tax receipts. So if the debt or the payments on the debt are growing a lot faster than the revenue coming in, obviously this is a problem. And if you look at the United States like a corporation, this leads to additional credit risk. And that's the main reason you saw a downgrade from Moody's. Now, the timing of the downgrade is interesting. I don't know why they didn't do this during the Biden administration, but I'll let you draw your own conclusions on that. So then we have to continue to think this through. What does it mean if the United States is a bigger credit risk? Well, the argument is that interest rates are going to go a lot higher, especially at the long end of the curve. Let's say the 10-year, 30-year. That increases rates in the real economy, rates such as mortgages. But it doesn't end there, because this would be a drag on the economy, so the Fed would have to come in and do yield curve control. They'd have to buy the long end of the curve. Therefore, they would have to, quote unquote, print money, and this puts downward pressure on the United States dollar, increasing inflation and making rates go even higher, which would make the Fed print even more. Now, I want to be very clear. This isn't necessarily my view. I'm just explaining the mainstream narrative and what you're going to hear if you turn on CNBC or go to financial Twitter. But before we move on, I want to point out something very important. Down here, when we get to this thought experiment, it assumes that all this equals interest rates going up. And that would prompt the Fed to come in and do yield curve control. But what if interest rates don't go up? What if they actually go down? Step number 2. Now, to know if interest rates are actually going to go up, or the probability of them going up as a result of this debt downgrade, the good news is we actually have prior debt downgrades. You see, there's 3 ratings agencies, and 2 of the 3 have already downgraded the United States debt. Moody was just the outlier. They were the 3rd one that has now joined the debt downgrade party, if you will. But the first downgrade of the United States was back in August of 2011. So we can just go ahead and look at a chart of the 10-year Treasury yield from, let's just say, 2010 to today's date, and you can see that interest rates did not skyrocket. In fact, interest rates went straight down, and they continued to stay down for a long time. So we can safely assume the first downgrade didn't lead to higher interest rates. In fact, if anything, it led to lower interest rates. Why? More on that in just a moment. But let's go ahead and fast forward to the next downgrade, and this was in August of 2023. Now, it is true, they did increase after this downgrade. They spiked, but then look what happened. They come right back down, and did they trend higher and higher and higher? No, we've pretty much been in a range, this choppy range, since that time, to the point where now we're at, call it 4.4, 4.5. But what I also want to point out about the second time this happened is the trend was already up. So if we go back to, let's just say, April of 2023, the 10-year Treasury yield started rising at this point, way before we got to August. And when these ratings agencies come out and downgrade the debt, it's not like anyone knows about it in advance. So the market wasn't pricing this in, is what I'm trying to say. So did the interest rates spike after August as a result of this downgrade, or was this just part of the overall trend? We'll never know because you can't prove a counterfactual. But what we do know is it definitely didn't lead to an upward trend in interest rates, which is what you're hearing right now in the mainstream media. Now, I know a lot of you right about now are saying to yourself, whoa, George, time out here. You just got done telling me that now it's time to really be concerned about this downgrade. But now in this step, you're saying that interest rates probably won't go up. And in fact, they're going to continue to go up or down, not based on a downgrade or deficits or supply of treasuries, but like you say in most of your videos, it's going to revert back to growth and inflation expectations. And what we've seen in past downgrades is interest rates have actually gone down. So wouldn't that be a good thing? Why are you telling me that now I should really be concerned about this? Well, I'm glad you asked, and I'm going to reveal the answer right now. Step number 3. So here's why the debt downgrade actually matters and why you should be concerned. So we start right here with the government, your drunk, insolvent Uncle Sam. And we have resources. So obviously we're oversimplifying the economy. So let's just assume in this super simple economy, we only have 3 resources. Now, as Thomas Sowell teaches us, these resources are scarce. They have alternative uses. So in this super simple economy, we have human resources, people. We have steel. I have no idea what steel looks like, so you'll just have to go with the S. And we have oil. Okay, this makes sense. Now, in a free market, what happens is we have this thing called a price signal. And this allocates scarce resources with alternative uses very, very efficiently. So the economy is maximizing on the scarce resources it has, and therefore economic growth is as high as it possibly could be. In other words, the economy is running on all 8 cylinders. Let me show you how this works. So we've got the United States right here, obviously. You can tell there's Florida. And up here in the Pacific Northwest, we have everyone's favorite, Moody the Millennial, with their blue hair. Now, Moody the Millennial wants to build some housing, let's say. So they're in the market for some steel or lumber, whatever it is. And they're willing to pay $75. But Texas Tim is down here, and he is willing to pay $100 for the steel or lumber. Okay, well, why is that? Because no one wants to live in the Pacific Northwest because it's a dump. Because everyone there is homeless and a drug addict and working at Starbucks. So they all go down to Texas. Sorry, I grew up in Portland, Oregon, so I'm allowed to say that. You guys know I'm overgeneralizing. It's a joke, for heaven's sakes. It's a joke. So all these people want to get the hell out of Dodge, so they go down to Texas. So Texas has this flow of population, therefore they're bidding up the prices for things like residential homes, things where you would probably need lumber or steel, or probably all 3 of these resources. So then what's going to happen is, because Texas Tim or Tom or whatever I said his name was, he's bidding a higher price, then these scarce resources with alternative uses are going to go to Texas instead of going to the Pacific Northwest. And at the end of the day, who is the decision maker here? It isn't Texas Tim. It isn't really the people selling the scarce resources. It's the consumer. It's the average Joe and Jane. Because they're going from here to here. They're voting with their feet, if you will. And therefore, this, at the end of the day, is what is allocating scarce resources with alternative uses. And that's why the free market and this price mechanism is so important. So if prices are going up, the bottom line here, the main takeaway, is that's where the resources are going to go, because that's where they're best utilized. And if prices are going down, then resources are going to move away from those areas because those resources aren't being utilized, or there's not as much demand for them from the consumer, the average Joe and Jane. This is why a bottoms-up approach is always better than a top-down approach. So let's go back to your drunk, insolvent Uncle Sam. So what does he do? He goes out to the marketplace or the real economy, sometimes the financial economy. I don't know if you could include that in there. But he's either going to sell bonds or he's going to tax the average Joe and Janes here. The bottom line is he's going to get dollars. So he gets these dollars and he looks around and he's like, how can I allocate these dollars to buy the most amount of votes? So let's assume in this scenario, he assumes that he's going to be able to buy the most amount of votes from Moody the Millennial. Obviously, we're not talking about Trump here. Although any government, I don't care who's running it, is going to misallocate these resources. So your drunk, insolvent Uncle Sam takes the money, buys the scarce resources, and takes those scarce resources and allocates them not to where they're going to be utilized in the best way, but where they're going to be wasted. The Austrians call this a misallocation of resources and malinvestment. So a lot of you watching this video right now are probably saying, okay, so what? So we've got some resources that go over there. What's the big deal? Well, the big deal is this wildly distorts the economy. And what this means for each and every one of you is that means economic growth is lower. Now, it might not drop, but it's lower than it otherwise would have been. And what that means is the standard of living for all of us, especially the poor and middle class, deteriorates and is much, much lower than it would have been if these resources were allocated to where they're going to be utilized in the most efficient manner by the free market and the price signal, price mechanism, instead of this misallocation of resources by your drunk, insolvent Uncle Sam. So what I'm trying to illustrate in this video is we have a huge problem with the deficits and the debt going higher and higher and higher. And this Moody's downgrade should be a wake-up call to all of us. But that problem isn't necessarily in the Treasury market, and it's likely not going to show up in higher interest rates. The problem is in the real economy, where unfortunately the price will have to be paid by all Americans, but will disproportionately negatively impact the poor and middle class. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.